Hello, welcome back to International Finance. So today's topic is going to focus on international portfolio choice and market segmentation. So let's jump right in. Our previous lecture, we looked at different option strategies. We looked at foreign direct investment, and we used real options as a way of understanding those foreign direct investment decisions. Our very last lesson looked at the cost of capital. We applied the CAPM locally and globally. We looked at cross-listing as a means of accessing global markets, and we showed how this can reduce the cost of capital because of diversification. Lastly, we spent quite a bit of time to develop the fact that investors are home biased, and we said this is driven by barriers to global investment on the demand and supply side. This week, we're going to drill even further into international portfolio choice. So this is going to focus mostly on chapter 15. This lecture, it's going to come from the perspective of a marginal investor or financial manager. And the key idea is that we're going to identify the optimal trade-off between risk and return. What will we do? First, we're going to refresh portfolio choice. So we'll talk quite a bit about return, risk, and diversification. We'll apply the Sharpe ratio to identify the optimal risky portfolio. We'll build the international CAPM. We'll add risk factors, size, book to market, investment, profitability, and then we'll test for international arbitrage opportunities. We'll estimate regressions and check for alpha and basically use regression coefficients to figure out what a fund manager or what might be inside of a portfolio. So what do investors want? We will assume that the marginal investor is risk averse, so she likes returns, does not like risk. That is, that the person that is buying or selling the asset wants higher returns and lower risk. We will also assume that the investor is not a large or controlling shareholder. What do these assumptions mean? These assumptions mean that the investor will take the return and risk of a security, portfolio, or market as a given. Very different from FDI, where investors have corporate control. For example, the investor does not increase expected returns by replacing bad managers, nor reduce risk by pushing the firm to a less volatile industry or shifting international operations to countries with stable exchange rates. We will manage risk and return with portfolio choice. Suppose you have 10K US to invest in one asset. You can choose between the world market portfolio with an average return of 10% and a standard deviation of 19.6%, or a 30-year US bond with an average return of 2.5% and a standard deviation of 2.13%. Clearly, you can see that these are very different assets. We've got the market, risky with high return, and we've got the safe asset, the US government bond, 30-year bond, much lower return, much lower level of risk. Depending on your degree of risk aversion, you might pick the market, high risk and high return, or the 30-year bond with low risk and low return. Our assumptions thus far will not identify which investment is the good match for you. So let's start by looking at how both these assets have performed over time. What am I showing you? These are the annual returns from 1991 to 2019 of the world market portfolio and of the US risk-free rate. This data is obtained from Ken French's data library. It's a great resource for returns, factor models. It's something that we all kind of use within the profession. So what do you see? See how the red line is all over the place? You can see how there are periods where it's really high and periods where it's really low. The red line is showing you the annual return for the world market portfolio. The blue line is very boring. It's very stable. And that's what we saw from the standard deviations. So when we're comparing the performance of the market and of the risk-free rate, we can see that these assets have very different expected returns and very different degrees of volatility. So which asset should you choose? The previous slide shows that the market has 4 times the return and 8 times the risk of the safe asset. That is, the market has a much higher expected return and volatility than the government bond. Our marginal investor is risk averse, so she likes returns, does not like risk. Do we select the asset with the highest expected return or the lowest risk? This is kind of the trade-off that we'll be facing as we think about portfolio choice more broadly. And really, it's going to depend on the risk aversion and the shape of the utility function. When I say shape of the utility function, I mean it depends a lot on what's going to make the investor happy. If the investor were risk neutral, meaning they cared about return but were indifferent to risk, we'd pick the asset with the highest return and be done. That's fairly straightforward. But because we're in a world where our marginal investor is risk averse, we have to align our financial goals of high expected returns with our preferences for low risk. That's what we're going to be doing with our portfolio choices. And we see this in the real world with financial advisors all the time. A good financial advisor is going to assess what your risk preferences are and then use those risk preferences to map the kind of portfolio you should be holding given your risk tolerance. So this is from Charles Schwab's risk tolerance discussion. Quote, once you know where you fall along the risk spectrum, the next step is to become familiar with typical performance data for your portfolio. The more you know about what you can expect, the smaller the chance that you will react emotionally when times get tough. That is, you need to align the expected return and the portfolio's risk. And you can see that Charles Schwab has produced a set of hypothetical portfolios. You've got a conservative, a moderate, and an aggressive. All of this is basically holding a portfolio over a 40-year period. So you start with 10,000 and you can see the aggressive portfolio has the highest expected return. It has an annualized return of 10%. It also has an annualized volatility of 20.5%. So very comparable to what we saw for the world market portfolio. And it has a maximum loss of negative 44.4%. What is the takeaway? Well, the key idea that's going to be working in the background of all of the discussion that we have on portfolio choice and all of the application that we have of the CAPM, what's working in the background is this idea that as an investor, you're risk averse. So you really want compensation for bearing risk. And then our question will be, well, what's the most efficient way to get you that compensation? What's the best bang for your buck? If you have to bear risk, what's the most efficient way that we can create a portfolio for you to do such? So let's jump in. We need to simplify the portfolio choice problem. Since we like return and do not like risk, we want the optimal risky asset. Specifically, we need to identify which assets most efficiently trade risk and return. How are we going to do that? We're going to use the Sharpe ratio. The Sharpe ratio is going to be the best way for us to identify which asset has the best trade-off of risk and return. In the numerator of the Sharpe ratio, we have the excess return for the asset. So the return for the asset minus the risk-free rate. In the denominator of the Sharpe ratio, we have the standard deviation, the volatility, which is, again, the way that we're thinking about risk. So what is that telling me? That's telling me per unit of risk, what's the excess return? Pause for a moment and think about this with me. If this wasn't the Sharpe ratio, if I told you this was the price of bananas or the price of some good that you would get from the grocery store, all things held equal, you would want to get the biggest bang for your buck. Let's make sense of that. If I told you that you could pay $4 for a banana or $2 for a banana, you'd rather pay $2 for a banana. Why? Because you'd rather pay a smaller price for the thing you want. Here, the price you're paying is volatility. So I'd much rather pay a smaller volatility conditional on having a higher expected return. Stated differently, I want to maximize the Sharpe ratio. The higher the Sharpe ratio, the more efficiently the asset, investment, security, or market is dealing with risk. Why am I saying that? Because the Sharpe ratio is the excess return for the asset divided by its volatility. So the higher that ratio gets, the larger per unit of risk I'm being compensated as an investor. So what can we do? How can we use the Sharpe ratio to identify which asset we should hold? And what if we decide to hold a risky asset, a safe asset, or multiple risky assets? How in the world can we reduce this problem? Well, let's go through. Suppose you were given the following information about two assets. You've got the expected return for asset A, which is 12%, and the expected return for asset B, which is 10%. Asset A has a volatility of 8%, and asset B has a volatility of 7%. Assume that the risk-free rate is 3%. Find the Sharpe ratio of asset A and B. Questions to ask yourself. First, which asset would a risk-neutral investor choose to hold? Hopefully, this feels very intuitive. Remember, if you're a risk-neutral investor, do you care about the risk-return trade-off, or are you only focused on expected return? Which asset has the lowest volatility? Well, that's direct. We can see that one of these assets is safer than the other. But what we want to know is which asset is the optimal risky asset. How are we going to do that? What's our tool? Our tool will be the Sharpe ratio. So as you set this up, you'll be comparing the Sharpe ratio of asset A and asset B. And clearly these assets have different trade-offs. Example 1 shows that asset A dominates asset B. Asset A has the highest Sharpe ratio. Per unit of risk, asset A has higher excess return. That is, assuming that we are risk averse, if we had to select one asset, we'd rather pick the asset with the highest Sharpe ratio. We want the biggest bang for our buck. We want to make the most we can conditional on the risk. What is the Sharpe ratio of the risky asset and the safe asset from slide 5? So if you remember, we started the lecture by comparing the risk and return of the world market portfolio and of the safe asset. And what if we decide to hold the risky and safe asset instead of only investing in one? So there's an important distinction that I would like to make clear here. In this example, we're trying to pick between two risky assets. And what we've said is that if we are investors that are risk averse, meaning we care about this risk and return trade-off, the way that we're going to pick the optimal risky asset is by looking at its Sharpe ratio. That Sharpe ratio, the one that the portfolio or the asset with the highest Sharpe ratio, may not be the one with the lowest risk, nor may it be the one with the highest expected return. What we're going to do now is to compare the Sharpe ratio of the safe asset and the risky asset that we used to open the lecture. So what is the Sharpe ratio of the risky and safe asset from slide 5? The Sharpe ratio of the world market portfolio is 0.38. How did we set that up? Well, we've said that the average return for the world market portfolio over the sample period was 10%. The risk-free rate's average return is 2.5%. And the world market portfolio has a volatility, a standard deviation, just short of 20%. So we plug it into our equation, and what do we find? We find it has a positive Sharpe ratio. What happens if we do that same step for the risk-free asset? Well, if you have the risk-free rate minus the risk-free rate, everything else is going to be zero. So what's the takeaway? Clearly, the Sharpe ratio of the risky asset is positive, and the Sharpe ratio of the safe asset contains no information. So it's not really a good way for us to evaluate our safe asset. Let's go a step further. We'll make a simplifying assumption that the volatility of the safe asset is zero. That means that the safe asset will have no variance and no covariance with anything. To make sure we understand why, the reason why we're assuming that the volatility of the safe asset is zero is because if we take a look back at that graph that we plotted on slide 5, remember the safe asset, that risk-free bond, was very stable. Its prices were very stable. An alternative way for us to motivate the safe asset having zero volatility is to remember that because it is a risk-free bond, at any point in time, I know what the return will be for that asset. Through time, it might change, but today I know what the guaranteed return is for tomorrow. Okay, so assuming that the safe asset has no variance means that it's also going to have no covariance. If it doesn't move up and down, if it's not changing in value, then it can't move up and down with anything else. That's fantastic for our portfolio. That reasonable assumption means that if we hold both the risky and safe asset, the safe asset will not add any risk to our portfolio. And we'll see this explicitly later when we get into portfolio variance. Assuming the risk-free security has no volatility, let's see what happens if we decide to hold both assets. So a good way to keep this in mind is to remember this Charles Schwab's risk tolerance discussion. Why? For two reasons. First, notice that for the Charles Schwab hypothetical portfolios of conservative, moderate, and aggressive portfolios, each of these portfolios has different weights on different asset classes. So the aggressive portfolio is tilted towards stocks, barely holds bonds, and very little cash. On the other extreme, the conservative portfolio is mostly holding bonds, then pretty comparable levels of stock and cash. So the key idea is that we're going to play with our portfolio weights to identify the kind of expected return and risk that we want. And again, all of this is conditional on us being risk-averse investors. The other small point that I want to make super clear is that in our setting, we're always going to assume that our portfolio weights sum to 1. We want to use our full capital. Every dollar that we have, we want to invest it. But our portfolio weights don't have to be positive. So in the Charles Schwab example, we have positive portfolio weights. How could we have a negative portfolio weight? Well, that would involve us taking a short position in one of the securities. So let's move on and kind of do our example. We're going to begin by plotting the expected return and volatility of the risky and safe assets. Notice the risk-free return has 0 variance. So if you don't see that on the graph, if you look at the vertical axis right there at the origin, just go straight up, you'll notice a blue dot. Okay, how will we form a portfolio that combines both assets? Before we do, what do you observe? Do you see this positive relation between expected return and volatility? Of course you do. Why do you see that? Well, you can see that the safe asset, which has 0 volatility, has the lowest expected return. And our risky asset, which has a standard deviation of around 20%, has the highest expected return. So that feels intuitive. That feels correct and consistent with what it is that we think should be happening in the market. So let's form our portfolio. How are we going to do that? We're going to use portfolio weights. We'll define W as the weight that we put into the risky asset. So 1 minus W will be the weight that we put into the safe asset. And to help make sense of that, remember, we're always going to assume that our weights sum to 1. We want to use our full portfolio. We want to use all of our capital when we're making our portfolio choice decisions. So when we create a portfolio of the risky and safe asset, we're drawing a line that runs through the 2 points. That's all the portfolio is. It's a line that runs through the 2 points and actually beyond the 2 points as well. Okay, so what do we have? The expected return for our portfolio will be a function of the expected return for our risky asset, the market, and our safe asset, the risk-free rate. The weights that we put on 1 determine the expected return for the portfolio. Remember, if we have a weight of 0 on the risky asset, that means we have a weight of 1 on the risk-free asset, and vice versa. And again, our weights are not bounded to be positive. We could have a weight of 1.5 on the risky asset, which would imply that we are shorting the safe asset. Okay, so each point on the line is a different portfolio. Remember, we are selecting where on that line we want to be, conditional on how much risk we can tolerate and the expected return that we would like to achieve. So that line, that blue line that runs through those 2 points, you'll also notice that there are 2 dots on that blue line. W equals 0, that's if we have a portfolio that has a weight of 0 on the risky asset, so we're only holding the risk-free asset. W equal 1 is if we have a portfolio that has a weight of 0 on the safe asset and a weight of 1 on the risky asset. Okay, so we can see that there's a positive relation between risk and return. When we started the lecture, we could only pick between assets. Now we're able to combine assets. We're able to use portfolio weights to figure out what's the optimal or what's the best way to mix the risky and the safe asset, given our risk tolerance and our target expected return. That is fantastic. The CAPM has something to say about the portfolio that we just formed. So the CAPM predicts that the market is the portfolio that has the highest Sharpe ratio. That is, it predicts that the market is the most efficient trade-off of risk and return that we can hold. All right. Suppose the red line is the portfolio that we create from combining the safe asset with the secret risky asset. So notice how the red line is above and to the left of the blue line. Let's make sure that we can make sense of this before we go further with the lecture. Every point of that red line is above the blue line. What does that mean? That means that for every level of risk, so take your finger and go to 5 on the standard deviation and go straight up. What you'll notice is that you'll hit the blue line before you hit the red line. What does that mean? It means that for every level of risk, the blue line has a lower expected return than the red line. Okay, so that's one thing to keep in mind. Secondly, we know from the CAPM that the CAPM predicts that the market should be the portfolio that has the highest Sharpe ratio. But if we compare the blue line to the red line, what we're saying is that there's some secret asset, some secret risky thing that if we form a portfolio of it plus the risk-free rate, we can actually do better than if we formed a portfolio of the safe asset in the market. Remember, the way that we formed our blue line was by holding the government bond and the world market portfolio. So let's answer these questions. Keep in mind that we have all this info. Let's address these questions. Does the secret risky asset have a higher or lower Sharpe ratio than the market, the blue line? Clearly, it's going to have a higher Sharpe ratio. Why? Because for every level of risk, it has a higher expected return. It has a higher excess return per unit of risk. And the way that you can identify that is because it's steeper than the blue line. Does the red line support the CAPM? No, it does not. Under our CAPM, the world market portfolio should be the most efficient portfolio that exists. If we've identified some secret risky asset where if we mix and match between our risk-free bond and our secret risky asset, we can do better than holding the world market portfolio, then our CAPM is failing us. And again, when we say do better, what we mean and what we'll always mean is the efficient trade-off of risk and return. Multiple risky assets, where are we? Thus far, we've been able to identify the optimal risky asset. We said this will be the asset that has the highest Sharpe ratio. Thus far, we've defined risk as the asset's volatility. Side note, we're using expected return because we're uncertain what the asset's value will be tomorrow. Remember, we assume that our risk-free rate has 0 volatility. If we know for certain what the value of the asset will be tomorrow, then it would be risk-free. Okay, next, we're going to focus on building a portfolio that combines many risky assets. We're going to use equity markets of publicly listed firms, but keep in mind that the other assets that we're ignoring are also important. So human capital, real estate, bonds, patents, intangible assets like brands, business models, etc. Those are all very important assets. And a limitation of our ability to apply and test the CAPM is that it's really difficult for us to create a true market portfolio that totally reflects all of these assets. In theory, those assets should be reflected in our stock market, but they may not be perfectly reflected in our stock market. So just keep in mind that that is something that's important. Okay, what do we have? We're plotting the standard deviation. So the horizontal axis, our x-axis, is the volatility of these markets. And then our y-axis, our vertical axis, is the expected return, the average annual market return for 80 plus countries. So from 1990 to 2019, these are the average returns and volatility of the 80 plus countries that pretty much identify 99% of the world market portfolio. What do you see? Well, there seems to be kind of a weakly positive relation. There seems to be a generally positive relation between expected return and risk. We also see that there's a ton of blue dots. So we really need a way to kind of reduce the complexity of this problem. So let's do it. Again, we've identified the optimal risky portfolio as the portfolio or asset that has the highest Sharpe ratio. And we form portfolios that combine the risky and the safe asset. As we combine multiple risky assets, we'll quickly see that the problem can be reduced to something very similar to what we had with one risky and one safe asset. Let's construct efficient portfolios for many risky assets. How? We're going to combine the risky assets into portfolios. Then we're going to minimize risk for any given level of expected return. So we have a portfolio that's a bunch of risky assets. We pick portfolio weights. Each of those portfolio weights is going to generate a level of expected return and a level of variance for our portfolio. Our rule, the way that we're going to move forward, is conditional on our level of expected return. We're going to minimize the variance. This will produce an efficient frontier of portfolios. That is, we're going to produce a line of efficient portfolios that each have the highest Sharpe ratio for any given level of expected return. And if that feels confusing, or if you're not quite sure why that makes sense, remember, your Sharpe ratio is the excess return divided by the volatility. If we have a target level of expected return, then we're holding the numerator of our Sharpe ratio constant. And the way that we're going to maximize it is by minimizing the denominator, by shrinking the variance of our portfolio. One portfolio along the efficient frontier will have the highest Sharpe ratio in the world. In theory, this is the building block of the CAPM. To get there, we're going to need to apply statistics to calculate the portfolio's expected return and variance. As we apply stats to the portfolio choice problem, it's going to reduce to 3 questions. What is the expected return? What is the risk? What is the risk? And do the portfolio weights sum to 1? This whole idea, it's called the Markowitz problem. And the idea is to minimize portfolio variance subject to expected returns reaching some target level and your portfolio weights summing to 1. This was named after Harry Markowitz, who won the Nobel Prize in Economics in 1990. This work, the portfolio choice, portfolio optimization, all of the stuff that we've basically built an industry off of, was his dissertation. At the time when he presented this dissertation, it wasn't even considered economics. It was pretty controversial at the time. So it's amazing to see where things end up. Okay, let's jump in. The expected return for the portfolio, it's going to equal the portfolio weights multiplied by the expected return for each asset. Hopefully, that feels familiar and intuitive. We just saw this when we had one risky asset and one safe. We defined W as the weight that we put into the risky asset, and 1 minus W was the weight that we put into the safe. And we noticed that our portfolio return was a function of the weights that we put on those assets. Okay, so that makes intuitive sense. If we apply the notation, we've got the weight for asset 1 multiplied by the expected return for asset 1, the weight for asset 2 multiplied by the expected return for asset 2, and so on. So what's happening? As we add more and more assets, the problem's going to grow larger. So for the next slide, I'm going to use matrix notation to keep track of the assets. You'll see what this actually looks like. So what is happening? With matrix notation, W, our portfolio weights, will be a column, and R, our expected returns for the assets, will also be a column. In order for us to multiply W times R to figure out an average, we're going to have to do something to W. The dimensions of these two different vectors won't allow us to multiply them together. So what do? We transpose W. You see this hash mark here in between the W and the R? That little tick sign, that's because we're transposing it. It means we're flipping it from vertical to horizontal. Okay, so let R1, the expected return for asset 1, be 10%. Let R2, the expected return for asset 2, be 8%. If W1 is 0.75 and W2 is 0.25, what's going to be the return for our portfolio? We're going to multiply our weights by the expected returns of the individual assets. That's all we're doing. Okay. So what have we done? We figured out how to calculate the expected return for our portfolio. That's fantastic because we're going to want to, again, minimize the portfolio variance subject to our expected returns reaching some target level. So what remains? Well, we still got to understand risk. So let's jump into it. The variance for the portfolio. The variance for the portfolio will be the portfolio weights pre and post multiplied by the variance covariance matrix. What does all that language mean? We've got our portfolio weights, we multiply them by the variance. We're doing it pre and post for a reason that I'll explain in a moment. Okay, so let's just look at the variance for a portfolio consisting of two assets. We've got the weight of asset 1 multiplied by the variance of asset 1 multiplied again by the weight of asset 1. We've got the weight of asset 1 multiplied by the covariance of asset 1 and asset 2 multiplied by the weight of asset 2, the weight of asset 2 multiplied by the covariance of asset 2 and asset 1 multiplied by the weight of asset 1, and then the weight of asset 2 multiplied by the variance of asset 2 multiplied by the weight of asset 2. Quite a mouthful. A few things. First, the covariance of asset 2 and 1 is the same as the covariance of asset 1 and asset 2, meaning they're the same thing. So that's going to help to reduce some of the complexity. Also, we know that if we've got the weights multiplied by themselves, so weight 1 times weight 1, that's just weight 1 squared. So we can kind of clean up some of this notation. If we simplify it down, what do we have? We have the weight squared multiplied by the variance. So the weight of asset 1 multiplied by the variance of asset 1, the weight of asset 2 multiplied by the variance of asset 2, plus it should be 2 times the covariance of R1 and R2. So what happens when one of these assets is risk-free? What we love about the asset being risk-free is that it has no variance and no covariance. What does that mean? It means when we have a portfolio that consists of a risky asset and a risk-free asset, only the risky asset will increase the variance of our portfolio. Only the risky asset adds risk to our portfolio. And that makes intuitive sense. Okay, so let's look at this within matrix notation to make sure that we're all on the same page. What is happening? We've got W, which is our column for our weights. We've got sigma, which is our variance covariance matrix. And then we've got W again. So why do we have this weird pre and post multiplication? Why are we doing all that? We're doing all that because that's the way that we calculate the number. What we want is just one number. We want a scalar value, one number that tells us what the variance is. And in order for us to be able to add up all of this with the variance and the covariance terms and the weights, we have to pre and post multiply our variance covariance matrix by our weights. So when we do that, we solve it down and we get a volatility for our portfolio. Okay, so we've established how to estimate or how to measure the expected return for the portfolio. We know how to measure risk for the portfolio. We still haven't really said much about the weights. What I'll say as an aside, notice in all of our examples, we've had our weights sum to 1. And that's always going to be true. Your weights will always sum to 1. They don't all have to be positive by any stretch of the imagination, but they will always